Welcome to On the Mark. I'm your host, Howard Mark Rubin. I am so excited to present this podcast series addressing our rapidly changing world and how it is affecting industries and people in unique and interesting ways. As John F. Kennedy once said, change is the law of life, and those who look only to the past or present are certain to miss the future. The business leaders and personalities who I will be interviewing in these podcasts certainly look to the future. And I hope you come away with information and inspiration that helps you adapt in both your business and personal lives. You can find these podcasts on all major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, itsplatzer.com. Good morning, and welcome to On the Mark. Today, we're going to be talking about a topic that everybody's interested in. It's money. How to keep it, how to grow it, how to prevent losing it. And we have as a guest today someone who does that for a living. His name is Clifford Michaels. He's a certified financial planner for decades. To give full disclosure, he happens to be someone that manages a lot of my money, so I certainly have a lot of trust in him, and he does a good job. So I wanted to speak to him about the issues that we're facing today in a volatile financial world, and how someone should manage their money to make sure they keep it and to possibly grow it. So when they get older, like me, they have it and they can enjoy their later years in life. Welcome, Cliff. How are you?
Good morning, Howard. How are you?
Good. So I think we have to start off with the world we live in today.
Mm-hmm.
We have, at least since January, a very volatile type of a market. There are large swings, unfortunately, most of them in the wrong direction. And how should that affect how someone manages their money?
Mm. Okay, so that's a good question. You know, with regard to time horizon, somebody shouldn't be in the stock market if they have a very short time horizon. So it's normal for the stock market every year to have at least 3 to 5% correction. And even every 3 years to have a correction somewhere around 15 to 20%. And we've been very fortunate not to have anything like that since 2022. So if we're just looking at a big picture here, we had very good markets in 2023 and 2024. They got a little extended. And, we're all blaming Trump tariffs, and I'm sure that is part of the volatility right now. But the truth is that even in December and January, some companies were warning and giving negative guidance for 2025 because things got so extended. So we were ripe for a correction. And the best advice I would give anybody is to do dollar cost averaging, or to put a set amount of money aside each month or each quarter or each year in their 401k or in their investments, because if you're doing that on a regular basis, you take some of the volatility out of the investing, because you end up buying more shares at the lows and fewer shares at the highs.
So if someone has some money to invest, let's say they've come into an inheritance or they won the lottery, whatever it is, can you give me an idea of how someone in different age categories, say 20s, 30s, 40s, 50s, 60s, 70s, how that money should be invested? Let's say it's $100,000 that they have.
Sure.
How would someone in different, I know first they should get a financial planner to do it for them and not do it themselves.
Yeah.
But how should they?
Interestingly, I have 90-year-old clients that go 100% in the stock market and equities, and I have 40-year-old clients that like to be in short-term instruments like fixed income. So it really comes down to risk tolerance, for one thing. And the other part of it, and we do give questionnaires to everyone to find out what kind of risk tolerances they have. But the other part of it is, what is their objectives, right? So two people that each have 100,000 may have very different objectives. One may need to live on the income, and the other person may not need the money right now, wants to put it away for retirement. So when we look at something like risk tolerances, it tells us how to allocate that money, right? So if somebody's willing to take a little more risk and they're a little more aggressive, their portfolio allocation might have more stocks, may have more mutual funds and equities and so forth. And if somebody's conservative or moderately conservative, they may have more fixed income. and that sort of thing. So we balance the portfolios, and that's how we go about it. And it all comes down to risk tolerance.
So, aside from risk tolerance, which I understand, I would think that your recommendation is that younger people, because they have a greater horizon, should be in the market more. Should that also mean that they should be in more aggressive types of stocks? In other words, should they be in the stocks that are the tech stocks, maybe the stocks that are potentially greater rises? How do you feel?
Right. So the longer the time horizon, usually the more an investor can tolerate the ups and downs. So naturally, a 25-year-old can handle a correction in the market easier than somebody who's 68 ready to retire at 70. We'd have to be a lot more careful with that money. So that's very true, what you mentioned. I'm gonna say something else now, just in case you don't mention it. I wanna talk about how important it is to save early when you're young. So I'm going to give you two examples, okay? Say you're 21 years old and you can put $200 a month in every month until you're age 65, and you get about a 7% return, let's say. At 65, and 45 years of putting $200 a month, you'll have 800,000. Okay, so if you have the discipline to do something like that and you put $200 a month away at age 65, you'll have about 810,000. Okay, all right. Now, let's say somebody doesn't have the discipline or the maturity to put money away at age 21. They say, well, when I get to age 40, I'll settle down, I'll get married, I'll put away $500 a month because I'll have a lot more income at that time, right? So they put, in the second example, $500 a month away, same 7% rate of return for 25 years until they're 65. Guess how much they have? They have 406,000, even though they put more than twice the amount away every month. 500 versus 200. They only have half as much at age 65. That's the power of compounding. And that's why it's so important to get an early start. So if I can tell your listeners one thing, start today. Earlier the better.
Now, you used in your example a 7% return, which is a pretty healthy return. Most in bonds, I don't think you can get it generally in today's market. In most markets, you can get a 7% return.
Right.
If someone wanted to get a 7% return, which is the number you threw out, yes, where would you have them invest their money to get a 7% return?
Well, if you look at the returns in the stock market for the last 20 years or so, I think it's about 9 or 10%. And the bond market is about 4.5% or so. So, if you had a balanced portfolio 50-50, you'd probably get about a 7% return. That's also an easy number to work with because of the rule of 72. If you have a 7% return, your money doubles every 10 years.
So, is that the number, 7%, that you should be looking for over a course of years?
Well, I was trying to be conservative. A lot of folks in my industry use returns of 8, 9, and 10%. So I thought 7% was a conservative way to show that example.
But to get to 7%, you have to be, I think, for the most part, in the stock market. Is that correct? You're not going to
have to have in that example, I was thinking of at least 50% in the market, in the stock market.
Now, what do you feel about the different types of investments other than, what do you feel about things like preferred stock in a portfolio or strats or someone buying options? Explain to what these different things are and who they're
right. So we actually use some of these other, I'm going to call them alternate or alternative types of investments, because when somebody comes into an investment advisor's office and they go to Wall Street, they usually see, an allocation of equities, which is stocks, or mutual funds that invest in stocks, or ETFs, which are exchange traded funds, which is just another fancy term for indexes. All right. And then they'll see fixed income allocations, which can be government securities or corporate bonds, okay, to get the income part. And then they create portfolios. But we were back in COVID, which is not that long ago, and we had interest rates of 0%. We needed to look for ways that we could generate some sort of income or return without taking a lot of risk. One way was MLPs. Those are master limited partnerships where they invest in oil and gas production, and you can get 7 or 8% dividends from there. Preferred stock, which is another form of debt, which corporations issue. A lot of them don't have maturities. We call them perpetuity investments, and that they'll come out with an interest rate, and that'll be the interest rate for the next 40 years. And a lot of those preferred stocks come out at, and they're not equities, they're income, they're fixed income. They're a debt instrument that pay a lot of times 5, 6, 7%. So that can also act as an allocation. And then you're referring to buy rights, which is where companies actually at this point have ETFs, exchange traded funds, that actually buy the underlying securities, the stocks, and they sell options against them to create income. And so those types of investments exist as well. And some of those pay dividends of 7 and 8%. So there are ways to generate income for a portfolio without having to be in fixed income. And here's the twist. If you buy fixed income at 2 or 3% and rates go up, those bonds are going to go down. They vary inversely with interest rates. So it's a little bit risky, which is why during COVID, we wanted to stay away from fixed income because we didn't want clients to get investments that would potentially go against them. So we were looking for a lot of those alternative types of income, like you were referring to.
So people that go to banks and buy CDs, certificates of deposit, which I don't know, I'm sure you know what the rates they're offering now, but they're somewhat low, depending on if you're taking it for a year or 2 years or 5 years. But do you think that that's a good way to invest your money? To me, the returns seem low, and the instruments that you're talking about can still offer a level of safety, although maybe not FDIC safety, and get a much better return.
There are some folks who insist on CDs because that's the only way they can sleep at night. And so, and they're of all ages, actually. I can't pinpoint an age where they're more likely to say they want CDs. I have an 86-year-old woman that just got in touch with me this morning that wants to put more money in the stock market because she sees it going down. So there's no hard and fast rule here. But there are people who insist on having FDIC insurance, meaning that the $250,000 of the money that goes in the bank is insured by the government, in which case, regardless what the interest rate is, they're going to want CDs. And I think right now it's about 4.5% on a CD. So it's not terrible. It's okay. It's not going to necessarily be the right mix for a lot of people, but for some people that don't want risk at all, it's a risk-free rate of return.
I would think that certain people have a personality that they like gambling. They go to Las Vegas, or they'll gamble money. And I would think that the stock market offers an opportunity for these type of people with this type of a persona to gamble. Do you run across that a lot, that they want to go into the really high risk type of stocks? And what do you say to those people?
No question about it. There are people who think it's easier. It looks easier than it really is. And the longer that we're in a bull market, where the stock market's going up, the more these people reveal themselves. And I've had clients that have come to me saying that they are, rather conservative, but then they see the market going up for a long time and they start to want to roll the dice. So, and then what happens is that naturally the market at some point becomes extended, it contracts, and here we are, like we are right now this year. But there's plenty of opportunities for those people in penny stocks and meme stocks, and you're always going to have those types of people, but that's not the majority.
So if somebody comes to you and wants you to be their financial advisor, they say to you, I'm really interested in the penny stocks or the meme stocks.
Mm-hmm.
Do you ask them to sign something saying a disclaimer as to these are risky things that not what I'm recommending?
Actually, at this stage of my career, I can't take on those types of clients because of the licenses I have, and I only have so much protection and liability protection. So the people that hold my licenses don't want me doing that. The bigger firms at this point. a good question. I can't do it.
somebody told me years ago that I was in the stock market. Stock market was way up, and it was just before a crash. And I said, "Boy, what do I need a financial advisor for? This is easy. I'm making money. Everything's going up." And he said to me, "Don't mistake a bull market for intelligence." And it was a good. Because then shortly, maybe four or 5 months later, the market crashed, and I didn't look so smart anymore. So you got to look at these things, I guess, in the long term.
Yeah, the market can be a teacher, like anything else. And it's one thing if a client of mine says, "Look, I'd like to take a little bit of a gamble on something." That's fine, even if it's a penny stock. That's fine. But if somebody comes to me, like in your example, and says, "This is what I want to do," that's where it becomes problematic.
Right. And do you try to time the market? In other words, right now everything's going down. I'm sure you have clients saying, "Boy, this stock I think is a terrific stock, and it's down 30%, 40%."
What I do, and I don't know if you figured it out yet, but what I do is I do sector rotation. And so there's always a sector that's performing better than another. There's always a sector that's has a little more safety. And when I talk about sectors, there's 26 sectors within the S&P 500 index, the market. You have telecommunications, you have technology, you have consumer staples, consumer discretionary, and commodities, and so forth. So I'll look for sectors that are performing better, and that's when I'll start to rotate and get out of the way of something that's not working.
One thing that I have that I thought was a good investment. Tell me what you think about this. Is an annuity that you could buy, like a policy with it, that it won't go down. If it's down, they'll make up the difference, or maybe give you a small return. It's based on the S&P. What do you think of annuities generally as an investment?
I think annuities have their place in the overall portfolio, especially the annuities that offer a feature called lifetime income. So you have two parts of the annuity. You have the growth period, or the deferral period, where you say you invest $100,000 and you let that go for 15 or 20 years, investing in various investment choices. And then when you're ready to retire, you want to, if you're going to buy an annuity, you want one that has that lifetime income guarantee. And you can flip that switch, and either based on how you've done or based on a guarantee that the insurance company gives you from day one, you get an income for life. All right. That's when the annuity makes sense. So then you use that as a complement to all the investing you're doing in bonds and stocks and everything else. And you have a guaranteed source of income. And that's the best way to build that investment pyramid, if you will.
And what do you think about just investing in, say, the top stocks? Have a half a dozen stocks, say, or the Magnificent Seven, which people talk about, which has not been so. It hasn't been so magnificent.
They haven't been magnificent.
It hasn't been magnificent.
They've been magnificently going down.
Yes, it hasn't been. But there's stocks that have proven and they've been around for a long time.
Okay, so that's a segue for me to tell you what I think is going on here. Okay, so I think we're having a normal contraction here economically, and that's maybe made a little bit more volatile by the communication coming out of Washington D.C. So it's like a 1-2 punch. You have a little bit of contraction in the economy with what's going on in D.C. and with the tariffs, and together it's really throwing the market off center. And because the Mag 7's a crowded trade, that's let us down, but everything seems to be rolling over here a little bit. So what I think is going to happen, the Federal Reserve, okay, is likely, well, I'm going to tell you, every time the market goes down significantly for a long period of time, it's the Federal Reserve that comes in and saves the day. But they told us they're not coming in until July. They telegraphed this to the analysts in the last month or two, that probably in July. I think they may come in a little earlier, but they can't come in a lot earlier. They can't come in this month, which is March, or next month, which is April. It's too soon. They need to see more evidence that inflation is under control. But once they get that evidence, like maybe in May, I think they can come in a month or two early and lower rates. If they do, it'll be the Mag 7 that come back first, because they're almost immune to tariffs, and they have true double-digit earnings returns. They have true, they have huge profits. Let's just put it like that, more than any other segment of the market. And that's why they're called the Magnificent Seven, because they performed so stellar over the last few years. And they'll continue to do that because you have the AI revolution. And actually, all those 7 stocks are monopolies, whether it's Microsoft or Apple or Google, Amazon, Meta, they're all monopolies. So we can look sometime in May or June when the Fed comes in. Those will be the stocks you want to be in to get back to even or even further than that for the rest of the year. That's my belief anyway.
I think, I don't know if you agree with this, that this administration, the way they're handling tariffs is very unusual, and it's not within that normal course of how the government is doing business. And it's very likely, I think, that we're going to end up in a recession, although recession is just a number. It doesn't mean anything in terms of actuality. It just means that we've reached a certain amount of regression in the market. If we are in a recession, if we get to the point of being in a recession, will that change the way that you advise people to invest their money?
Well, probably not, because recessions end. As I just described, the Federal Reserve will come in and be aggressive. And if they have to lower rates instead of once or twice, 3, 4, 5 times, they'll get us off our backs and, back in the game. So I don't know that it would change how I work. I would be a little more conservative in that I want to be careful about how I invest client money, but I would still go ahead and find those opportunities. During COVID, we started buying before the market went up. And that was a good year for clients, because eventually the market came back. I don't know that DC has bad ideas, but I think they communicate poorly. And I think that's what has the market upset. And I think of this sort of metaphor, if your next door neighbor builds a fence that's 1 foot over the property line on your property, and it's like that for 20 years, you're not going to come down and point a gun at your neighbor and tell him to move the fence. So you have to be careful how hard you want to tell other countries to change their tariff policy, the stuff that's been in place for years, if not decades, So I don't think it's a bad idea to try to get some sort of fairness, but you can't be so harsh about it that you start, economic wars with countries around the world.
So what do you think this is a little bit probably outside of the scope of investing, but it affects investing. What do you think is the most important goal at this point for the government to achieve? Would it be getting inflation under control, keeping unemployment low, keeping the interest rates to get them lower?
I can answer that. I can answer that very quickly. First of all, inflation is under control because the price of oil, which is one of the preeminent factors of inflation, the price of oil, I believe, has gone from $80 a barrel now to 65. So I think the inflation point, I think we're under control there. However, wait,
let me stop you for a minute. When you say oil prices, how about if you go to the supermarket and somebody is buying a dozen eggs or a container of milk?
Well, eggs have to do with the bird flu, and that's under control also now. But they killed a lot of chickens. They killed millions of them. That's why the eggs went up. But they're already starting to come down in price now. The eggs.
But when you're talking about the average consumer, we're talking more than just energy prices. That's one certainly important segment. But when you're looking at inflation in everyone's everyday life, there's more to it than just energy. Are you saying that it's your opinion that all inflation is under control, or just energy prices are under control? Or is that enough?
Well, I think if you do a deep dive, you find out that the price of oil affects inflation quite a bit more than anything else, because of course it affects trucking, and it affects manufacturing, and it affects everything along the line in the distribution of groceries and everything. It has a big factor in inflation. Your point is that, the grocery prices, especially eggs, went up recently. They did, but I think it's a blip because of the bird flu.
So the one of the issues in the last election was inflation hurt the Democrats, I think, certainly, and was a major issue in the election. Do you see an improvement overall in inflation, or do you think just that the energy prices coming down is enough to satisfy the everyday American consumer as to inflation being under control?
Okay, so the two big factors that caused inflation, one was the price of oil that went from like $40 a barrel to 100 and 110. Now it went down to 80 and now it's down to 65. And the other one was the printing of money. The Federal Reserve printed trillions of dollars to create all that money for the PPP loans during COVID and to create all that money so businesses could stay in, and not go out of business and not go belly up. And they kept printing that money, not just in 2020, but all through 2021. And so that punch bowl was only removed a little bit. So there's a lot of money. There's trillions of dollars in the money market still. So that's also part of the inflation problem, that there was so much money printed.
How about the deficit? The deficit under Democrats or Republicans, Democrats, it doesn't matter. It's trillions and trillions of dollars.
That's the worst.
I mean, is it important for the markets and for investment that we somehow do something about the deficit and do something about having a balanced budget? It seems that nobody, even though they talk, is really interested in a balanced budget. And
right.
It seems that ultimately every administration, and they always have some excuse for it, is increasing the deficit. It's not going to affect me in my lifetime, but it's going to affect my kids, possibly, maybe, certainly my grandchildren. There's got to be a limit to borrowing, or maybe there's not.
And that is the biggest problem. Before you were asking me what I thought was the biggest problem. I was leading up to this. I was going to say that the deficit is really problematic, and the problem also underlying it all is that everybody in Congress makes promises to all their constituencies of what they're going to do for them, and they all want to get things passed, and it continues to add to the deficit. At some point, and I think we're getting closer, countries aren't going to want to buy our debt, and so we do depend on countries around the world to buy our government securities. China is a big buyer. And so at some point, we really got to get that under control. I know they're trying to right now. Whether they'll be successful or not, there remains to be seen.
So our markets and our economy, although there's plenty of problems with it, are probably healthier than a lot of countries' markets. Do you advise people to invest money in international markets other than the American markets?
100%. Absolutely. It's part of our allocations. And we've been doing that for quite some time. And we increased those allocations to the international markets in the fourth quarter of 2024. And it's paying off because those markets have gone up a little bit in 2025. They're one of the few areas that have gone up.
See, I personally, the money you manage for me, I let you do what you think is right. But for the money I manage me, I stay away, for instance, from Chinese stocks because I don't trust the government could change things tomorrow. I don't trust their financial statements. I mean, I personally don't think it's reliable, and it's a deck of cards to me. How do you feel about Chinese stocks?
And, so
regulation.
When we invest internationally, we take two roads. One is the international developed markets, which is where most of our allocations are. The other road is the emerging markets. And so in the emerging markets, we're looking at one index that includes China, Russia, Brazil, and India. And there is growth there, especially in India and Brazil. So we do get a little China along the way. And Chinese stocks this year, for the first time in many years, are actually performing well. So we don't want to throw those away necessarily. But your point is well taken. It's not transparent. The government, does seem to create the parameters through which their businesses operate, and they can change things, overnight. So I do understand that issue.
What if somebody, for political reasons, doesn't like what Russia's doing, for instance, in Ukraine, or doesn't, frankly, like what Israel's doing in the Middle East? Should they stay away from investments in those countries, or should they overlook it because they'd be sound investments. Similar to what some people, I know my wife has said too, she doesn't like it when you put our money in tobacco stocks because she.
Oh, tobacco. I thought you were going to say something else.
No, tobacco stocks.
Because there's another company your wife doesn't like.
Yes. Starts with a T, I know. But that's
Yeah.
But that's
no.
She was right about that one.
It starts with a J.
Oh, Jay, that's a different one. Okay.
That's another one.
That's another one. She doesn't like Tesla either. But,
that's okay.
Good.
So we don't have any tips, but but when we invest internationally, Howard, we do a broad stroke. We don't really invest in Israel. We really invest in a multinational investment. And so under the hood in those international investments, we have Europe, and we have a little Asia, we have some South America, some Canada. The question about staying away from Israel or Iran or whoever, it doesn't matter. I leave that to the money managers that we tap on the shoulder where the best opportunities are, and we go with it.
Okay. And when you buy stocks, I don't do it myself, but do you put in stop orders that if a stock goes down a certain amount of money, it's automatically sold, or you just want to have that possibility of deciding?
It depends why it goes down, but usually I try not to let it go down more than 10%. And then I'll pull the plug if something's changed and it's down 10%. If nothing's changed at all and it's down 11 or 12%, I might stay with it. I might even add a little bit. But if it really starts to show that there's a problem, I'll take it off. And that's very important, not to take big losses. That's how you stay in the game. That's how I've been able to stay in the game forever here. You just don't let your losses ride. You let profits ride, but you don't let your losses ride.
So AI, artificial intelligence, is the big new thing. I don't know if it's so new anymore, but the big thing. Everyone's looking to invest in AI. Almost every company, some aspect of their business, has incorporated AI. How has that affected investing? Trying to chase the AI dream.
Are you? I just want to make sure I understand the question. Are you referring to AI in my industry, or you are talking about AI as an investment?
No, I'm talking about AI as an investment.
Oh, okay. So, with regard to that, there are still a small number of firms that are doing it, and it's those mega cap 7, those big 7 firms that are dominating in that area, along with some semiconductor stocks. It's not that hard to invest in AI because it's not been taken on. It's not all over the place. It's
well, there are a lot of semiconductor stocks, particularly in that industry, that are changing the chips to incorporate AI and becoming more AI sensitive. Are those stocks, because of their AI, are they someone you give priority to, or?
It's too early. It's too early. I can't say it. It's too early. Everybody wants to say that they're trying it on, but I'm not sure who has created a core competency in it yet. I think Microsoft is making some headway there, and Google is, and NVIDIA is in the chips. I think you also have to watch Microsoft because they announced recently that they have something called a quantum computer chip. Now, I don't know what that means yet, but it's supposed to be the next generation chip. So we'll have to keep an eye on them as well. And then, of course, you have Apple. And one of the reasons Apple's been selling off is because they've disappointed the market here. They were supposed to come out with their AI hardware in this generation, and they just announced a week ago it's going to be another 12 months. So AI is still in its infancy. It's in the early innings. And there's a ways to go before it really shakes out and you see who the big winners are.
Do you think that AI is going to replace people in a lot of industries, including you? I mean, can an AI program that's sophisticated enough replace you, and possibly, I don't know if I think I'm irreplaceable, but maybe replace you and replace accountants and replace a lot of other people?
it remains to be seen. You know, people that are clients of mine, a lot of them require a human touch. A lot of them require explanations and a human touch. So I'm not convinced yet that AI is going to replace me or people in my business. There may be areas of my field where AI can help. Just like at McDonald's, they have robots, I think, now. So there may be some places, maybe financial planning programs, there may be some other things, but people still require a human interaction, at least from what I've seen. You know,
You see, the change, and one of the things we talk about on the Mark is how the world is changing.
yeah,
For younger people, for teenagers, and for even younger, for people in their 20s, they spend all their time looking at screens or rolling them out. Someone in their 50s and 60s, no, they need that interpersonal connection. I talk about how when I interview attorneys to hire, they want to know, their main questions were, how much am I going to make and what's my chance of becoming a partner? In today's world, what they want to know is how many days a week they have to come into the office because they just want to work at home on their computer. So when you talk about people need the personal touch, I think to a large extent that has to do with age. And the younger people don't seem to want that personal touch. They don't seem to need it in the same extent.
Okay, I will agree with some of that what you just said. I have picked up a number of young people though in like the 25 to 35 age range in the last 2 years. Some have, when they've come into more money and they've tried to do it on their own, they've either have had obstacles or emotionally they're not comfortable. But when they don't have a lot of money and they're young, they don't require the human touch. So that part is correct.
How important is it to, I think you touched on this, to use things like Roth IRAs if someone is younger and qualifies under disqualifications,
Yes.
a shorter income. But are those vehicles important for savings?
Yes. I would say for any young person starting out, if you're single and earning less than $80,000 a year, or if you're married and you're under, I think it's $246,000 a year, you can open up a Roth IRA. You can put $7,000 a year in, and you should do it. It's after-tax money. If you can afford to do it, it's going to grow tax-free, and it's a terrific way of saving.
And I assume the same way I do it for my grandchildren, college savings plans, 529 plans.
Yep.
Done. These are important things that pay for college.
Critical.
Except in today's world, and this annoys me, at least the last administration, I don't think this administration feels the same way. They're talking about there is so much student debt out there. And to me, it was abusive. And when they can use student debt to pay for their rent and to pay to buy a car and to do things like that, there's trillions of dollars out there of student debt. And they're talking about forgiveness of this debt. Maybe it's not such a good idea to have college paid for because no one's ever going to have to pay it back.
That's a good point. I think the Supreme Court ruled not for the government to be paying down those student loans, if I remember.
But a lot of people, they have so much in student debt that in terms of investment and savings, they're never going to be able to pay that off. Or they won't be able to pay it off because they're not getting jobs that they're making enough money to pay off that debt and, have to save money to buy a house. And to do
so what's the answer? Do we have the government come in and prevent colleges from raising tuition as much as they do? I mean, it seems like the Ivy League schools that have billions and billions in endowments keep raising their prices up to about $100,000 a year now for tuition. I mean, it's getting ridiculous.
I don't know the answer. That's why I have you on. If you're a smart guy, you have to give
I think there ought to be some price controls on what education, what our institutions can charge, to tell you the truth. Now, I don't know how it's worked out, and I don't know if the government has to get involved. It's just a thought, because it seems like that's getting out of control. And I don't understand if they have $100 billion endowment, and they're able to help students why they have to raise their prices to 6 figures a year. I don't get it.
Well, Cliff, we're getting towards the end of the program,
Yeah.
but I wanted to give you an opportunity, because I'm sure there are things that I haven't covered that you think are important for people to know out there. So why don't things that I haven't covered that we haven't discussed that you think are important?
Yeah, well,
I'm giving you the floor.
sure. Well, I think we hit on two very good areas, which is to invest early, the power of compounding, and to invest in Roth IRAs. I think those are great. I have to tell you, I have so many clients that have families that don't do wills. You have to do wills, especially if you have children, because if you don't do a will and you die what's called intestate without a will, the state is going to decide who the guardians are for your children. If you and your wife die, or if you're just alone and you don't have a spouse and you have children, you have to have a will. And there are too many people that forget to do that. And so that's critical. Another thing is, especially when you're young and you're active, if you can afford it, you take out disability insurance, because that can happen at any age where you become disabled, and that gives you income replacement. Okay. And if you can get it where you work, great. If you can't, get your own policy. It's portable. If you do work for a company and you leave and you go somewhere else, you have your own policy, you still have the disability insurance. I think that's really important. And then when you have children, you got to have life insurance. If you can't afford cash value where the money actually defers over time, then buy cheap term insurance. But you got to have life protection for your family. That's important. And if you have a lot of assets, people sometimes forget to do umbrella insurance. People are always talking about how can they accumulate as much wealth as possible, but they forget to look in the rearview mirror and liabilities. I mean, you could, God forbid, you may get in a car accident and hurt someone, or somebody may slip and fall in front of your house. It helps to have that liability protection, which umbrella insurance offers. And if you have a lot of money and you're older, you can now gift up to $19,000 a year to someone without filling out a gift tax return. So gifting is also a way to lower the estate and to help out your loved ones while you're still alive.
Well, Cliff, I want to thank you for being on the mark. And I think you've raised a lot of great points that are helpful to people. If someone wants to speak to Cliff further, his email address is there. I can attest personally, he does a great job with my money, although I'd like to make more, but so would everybody else. So, Cliff, thank you for being on.
Thank you for having me, Howard.
Thank you.
Okay, take care. Bye.
I hope you enjoyed this episode of On the Mark. I started this podcast by quoting John F. Kennedy and would like to end it with quoting one of my favorite baseball players, Nolan Ryan. Enjoying success requires the ability to adapt. Only by being open to change will you have a true opportunity to get the most from your talent. I wish you success in staying ahead of the curve instead of behind the 8 ball. Thank you for tuning in.